Hello and welcome to the Crypto Beat. My name is Tim Copeland and I'm the head of growth at The Block. Joining me today we have Sun Raghupathi, the co-founder and CEO of Veda. Welcome to the show. How's it going?
Thanks for having me. It's going well.
Amazing. Before we get started, just a quick note, if you are hiring crypto, you should check out Campus. Or your candidates, it will help you pick out the real crypto natives. Head to theblock.co/campus to get a 3-month free trial. Now, today's episode is around crypto vaults. So at its core, what is Veda?
Veda is the largest DeFi vault platform. So maybe we can start with what are vaults? Vaults are basically tools for abstraction, right? DeFi is super complicated. There's all kinds of different protocols, bridges. Even people who've been working in DeFi for a long time sometimes find it hard to navigate. Vaults are basically a passive way for users to earn yield in DeFi. They abstract over all the complexity, all of the bridging, and provide a simple interface where users can just deposit their assets and earn yield. And so it's really amenable to mass distribution. In my view, vaults are the missing piece for taking DeFi mainstream. Veda is the leading vault provider, over $3.5 billion in TVL. We take a B2B approach. So we work with chains, asset issuers, protocols to allow them to build bespoke yield products for their users.
So how does that sort of work? As in you build you create a set of code, it works across maybe a certain number of chains, and you license people to use that code. Is that it?
It's a little more than that, right? So we have this foundational building block, which is our set of smart contracts. We called it the boring vault. It's this new architecture that we built from the ground up. So a vault is just a deployment of the boring vault, which with a bunch of off-chain services that we provide as well, right? So things like APIs for users to be able to see what's going on, analytics, SDKs for front-end integration. So it's really a full suite of services all the way from smart contracts to actually data that users consume to see what's going on with their positions. We provide that whole stack to our partners.
Okay. And how secure or how battle tested would you say your smart contracts are?
Yeah. So, just Veda canonical deployments hold $3.5 billion in TVL. There's never been a security incident on one of our underlying smart contracts. I could say a lot about why vaults are arguably more secure than other kinds of DeFi primitives. The short answer for this is if you take something like a DEX or a lending protocol, there's a million things you can do with it, right? You can compose different actions in different ways. There's weird things like flash loans. So there's just this very large surface area that it can be difficult to figure out, how do I safeguard this? For vaults, it's super simple, right? There's two public functions. There's deposit and withdraw. So with that surface area, you can build a ton of safeguards into both the entry and the exit to prevent to mitigate risk. So our contracts are pretty battle tested at this point. We've been live for a little bit over a year, again, over $3.5 billion in TVL. But there's also a ton of projects that have built on top of the boring vault standard. There's over a dozen protocols that have either forked the boring vault or, are working with us to develop their own version of it. And, this is, I wouldn't be surprised if the boring vault is one of the most audited pieces of code in the world because we've done a bunch of audits ourselves, but every partner that we use also does their own audit. So there's just this compounding effect as more and more people adopt the standard for security of our smart contracts.
Does that mean there's a sort of potential, I can't think of the word, but maybe contagion risk in a way? Let's say if there was an issue with the core sort of smart contracts, that could then apply to all of these vaults in one go?
Potentially, right? If there was some very critical fundamental logic error that affected all of the vaults. One very conscious design choice that we made is the core code is super simple. It's 100 lines of code. We built this with simplicity in mind. So it is very unlikely that the core vault itself has any logic error. Number one, again, it's a very small surface area for code. So, there's been a lot of eyeballs on this and users looking at it. But number two, the architecture is super modular. So it'd be pretty easy to update and just swap out the affected components if need be. So I don't think it's a major risk. It's a very, very simple and modular architecture, which means that it's easy to upgrade if need be.
And then you mentioned complexities of DEXs. Reports coming out that GMX may have just been hacked for around $35 to $40 million. We've just seen that we believe it's GMX team has sent an on-chain message offering a 10% white hat bounty and acknowledging the exploit. I haven't confirmed that myself. That's a real message, but it does seem that it's quite likely that it's been hacked. Do you have any thoughts on that taking place?
Yeah, I mean, first of all, like, my thoughts go out to anyone who's like in the protocol, and hacks are just rough, and DeFi's matured a lot, but it's still just part of the game. Like, we still have protocols getting hacked almost every week. I'm not super familiar with what the hack is. It just came out today, so like, definitely going to dig into it. But it's interesting because GMX has been around for a really long time, right? And historically has had a pretty strong track record. So I'd have to assume that this was some new logic or new code that was introduced, but we'll just have to see. It's it's a tough situation.
Yeah. And then the one thing that I sort of wondered about as maybe more of a closer parallel was the Bybit hack that involved Safe. And now Safe is different, but also similarly, they focus on multi-sigs, trying to keep, funds secure. It's not too dissimilar to vaults. And then obviously that was the largest hack. I'd have to check, but I think so. Do things like that sort of scare you at how easy it is for something like that to get through? Or is that just like a very different example because that's more of like a sort of custodial system?
So the important thing, that the big lesson from the Safe hack is the smart contracts were totally fine, right? It's not that the Safe multi-sig accounts were compromised in any way at a smart contract level. Rather, the hackers got access to Gnosis's off-chain systems, right? And they were able to do this very, very targeted attack that modified data for a single target, right? In this case, it was Bybit. So there's a ton of lessons there. Number one, it is terrifying, right? Like that patience, the execution of the hack is something that I don't think we've seen in the past. They could have, the exploiters could have done this to any Safe account, right? They had access to those systems, but they were very patient, they were very targeted, and they just modified that one transaction and that one address. So I won't say it could have happened to anyone, because there are things that, the Bybit team could have done to prevent it. Again, this type of exploit had never been seen before, so I'm sure Bybit was following kind of standard practices and not maybe, the exceptional practices that would be required to prevent this. But the lesson is that like off-chain systems can be compromised, period. Right? Like if your smart contract system or your protocol has a failure point in an off-chain system, that should automatically be where you think hackers are going to go first, right? And the like design lesson here is build your smart contracts in a way that even if your off-chain systems are compromised, it does not lead to like loss of funds. That's kind of one design choice. And the other is it should really be easier for people to see what's going on, right? Like the transactions that they're signing, the things they're executing. It's like, blind signing is just this horrible thing that still is very prevalent in the space. There hasn't been a solution to it yet, but I think there's a lot of teams that are working on it.
Yeah. What's the hardest part about making crypto vaults?
I'd say obviously security is really important. This is just true of any DeFi protocol. You need a security first mentality, but practically, so that's just like a prerequisite, right? You cannot have a successful vault if it's not secure. But growing a vault business, I'd say, is the challenges emerge with scale, right? It's super easy to have a single vault on a couple $1 million of TVL, but two forms of scale create new challenges. One is capital, right? Just practically, it's like, how do you earn yield on $1 billion? And how do you provide yield that is more attractive and, risk adjusted? There's that whole practical consideration. And then the second point of scale is, how do you support thousands of vaults, right? There's operational overhead. There's, all kinds of standard, let's say like software design questions. So that has proven to be the hardest thing. I don't think there is a vault provider that's operating at the same scale. And there's definitely a lot of lessons that we've learned as we've gone. So I do think it provides a competitive advantage to be in the market at scale for this long.
Now, DeFi Summer feels quite a long time ago. I'm sure many people in the industry now maybe weren't even around for DeFi Summer. It was a very different age where you had 1,000% APYs and it seemed normal. But would you say we're in a better position now to make DeFi more widely accessible than we were then?
Yeah, definitely. I mean, DeFi Summer is a time that is very dear to my heart. Like it was one of the most fun times to be in the space. Obviously, a lot of people also lost a lot of money. I think those like 1,000% APRs and just the crazy yield opportunities was really a function of risk back then, right? The risk back a couple of years ago was so much greater because we hadn't settled on like standard practices for smart contracts. We didn't know what kind of designs would work. There weren't really protocols that had been battle tested in production for years at a time. So to incentivize people to like take risk on these systems, put their skin in the game, you basically needed to provide high incentives. We are currently in like the opposite side of the spectrum in DeFi. I think DeFi has matured significantly. Yields have definitely compressed, but there are a handful of protocols now that are battle tested. They've been operating with billions in TVL and volume for several years now. And I think for the first time ever, we are now in a position where we can actually take these protocols and export them to the masses, right? A couple of years ago, it was not possible. It wouldn't make sense for any major fintech to actually offer DeFi products to their users because it's just too risky, right? But that's not the case today, right? You have protocols like Aave that have $40 billion in deposits. And that is a scale that is on par with some of these fintechs. Uniswap, right, been operating for a very long time, no security issues. So I think for the first time ever, DeFi is actually in its consumer adoption phase, institutional adoption phase, and it's probably the best time to be building in DeFi ever.
And are you seeing apps that are offering crypto vault products in a seamless way to consumers?
Many of the most successful DeFi apps today are doing this. EtherFi is a great example, right? EtherFi was actually our first partner when we launched Veda, and they have done a great job of utilizing our technology to build products that are used by, tens of thousands, hundreds of thousands of people. So EtherFi's liquid product line, one of the most successful vault product lines in the space. There's over $1 billion of capital across ETH, BTC, USD. We also work closely with partners like Lombard, Plasma. We had this crazy pre-deposit campaign that we supported Plasma for that did $1 billion in TVL in 30 minutes. Craziest launch I've ever seen. So it's been widely adopted within DeFi. I think it's not debatable. But we are increasingly seeing people outside of DeFi, right, and who are adjacent, like wallets, centralized exchanges, and fintechs, all becoming very interested in vaults. And if it's not already clear, over the next couple of months, we will see some of these platforms actually deeply integrate vaults directly into their UX. We're already seeing it with wallets. Centralized exchanges are coming very soon, and fintechs will inevitably follow.
Do you have an EtherFi card? I've seen there's a lot more sort of crypto cards coming out there and becoming a lot more competitive.
Yeah, I do have an EtherFi card, our company has one, and it's a great product, right? It's like built for degens, built for DeFi people. You get to earn, like 7-8% on ETH, and you don't have to sell it. You can borrow against it. Same with Bitcoin. So I think it's a great product.
And I noticed you're powering a BTC-Fi vault. How does that work in terms of providing for DeFi on Bitcoin?
Yeah, so I'm not sure if you remember, but like BTC-Fi was this very, very exciting prospect, probably 6 months ago, right? A lot of that was led by Babylon. And I still think Babylon is a really exciting project, and all of the downstream ones. We're really close with Lombard. They're a great team, and they have a massive scope of vision. So there's aspects of BTC-Fi that have not been proven out yet. I think one of those is like, where does the organic yield come from, right? What a lot of people are doing now is basically issuing staking rewards. So it's like inflation-based token emissions that provide yield on Bitcoin. Eventually, that will need to become sustainable, right? But on the other hand, there has been one very scalable structural use case for Bitcoin and DeFi, which is Bitcoin-backed loans, right? If you look at, where Bitcoin is sitting on chain, most of it is sitting in lending protocols, and most of what people are doing are borrowing stables to go and spend or to deploy into some higher yielding strategy. Bringing this back to fintechs, this was kind of the first major DeFi mullet or like DeFi integration into a consumer channel that has millions of users, which was Coinbase integrating Morpho with Bitcoin-backed loans. Massive integration, it's called the DeFi mullet. There's tens of thousands of users that are through Coinbase just depositing Bitcoin on chain, borrowing stables against it, and going and doing things with it. So that has interestingly proved to be this very, very successful use case, not just for like financing, but if you look at the stablecoin yield environment, take protocols like Maple, which have seen like really great growth recently. A lot of their secret sauce an alpha in providing yield is basically lending out stables against Bitcoin that's held in custody, right? And because they can offer fixed rate loans, you can get like 6% on stables, which is very difficult to get on chain or off chain. So Bitcoin has definitely, been integrated in DeFi. Like BTC-Fi is here. It's not as sexy and like, high yielding as people thought, but there's core structural uses that are in the billions already. And I think we'll see more of that.
And you touched on this, but in what ways are institutions getting involved in DeFi? I mean, you mentioned Morpho and Coinbase, but do you see anything more than that?
Yeah. So there's this interesting phenomena where today, most of the capital in DeFi is actually arguably institutional capital, right? It's not just people with their PA doing stuff. There are a lot of users doing that in the hundreds of thousands, probably. But it's mostly liquid funds, right? And institutions that are willing to take a little more risk. But to get to like proper institutional adoption where it's, the suits on Wall Street, that is going to take a couple of years, in my opinion. But I think before that, we will see fintech adoption, right? Like the people who are technology first see the virtues of DeFi and have to compete aggressively to offer the best products, like centralized exchanges, like fintechs. They are integrating that today. So it's a little bit more retail is what I would say is the next kind of wave of adoption. But institutions are very interested in this. We're clearly seeing them move on chain through RWAs and other channels.
And what institutions are you currently working with?
We have a lot of LPs. We have 100,000 users across all our products. Many of them are institutional. There's definitely a TVL power law. Without sharing too much about who they are, these are, traditional financial institutions, DeFi funds, high net worth individuals. So there's a lot of people using DeFi, right? Now, we're not at the point yet where someone like a Fidelity or a JP Morgan is actually going to offer a DeFi product, but we'll get there soon, right? And we're definitely seeing interest from that caliber of company.
And how do you think vaults will be used by traditional finance companies?
So there's obviously a ton of use cases here, right? If you think of vaults as the DeFi equivalent to like a fund vehicle, you can do things like baskets of DeFi yields that are offered to your clients. RWAs are this big thing, right? As they move on chain, there's demand for higher yield, higher leverage strategies. So, leverage loop strategies on RWAs, we're going to see those roll out. There's already a number of those that are out. I just think, vaults are this tool for capital aggregation, just like funds are, except they're better, they're cheaper, they're more transparent, they have checks and balances. So vaults will become the primary way that capital is deployed and optimized. That's our thesis. And there's going to be a number of use cases for that.
What do you think of Robinhood getting into tokenized stocks?
Yeah, I think it's huge. I know there's been some it's a bit controversial on the execution. Probably a little bit of the advertising was confusing to people, right? Given that this doesn't actually give you ownership over the stock and the same rights that holding a stock would. But I mean, I think it is directionally very, very interesting, especially the aspect of offering exposure to private companies, right? Like this is just a net new functionality that does not exist or has not been accessible in traditional markets. Yeah, huge. I mean, it's also a really strong signal, right? Like Robinhood is not going to stop here. They're going to keep going. There will be DeFi on the Robinhood chain. So it could not be more bullish for the industry to have, a company of that caliber that's very DeFi forward.
Yeah, it's definitely interesting to see the competition between these big exchanges, Coinbase, Kraken, Robinhood, and that they all have their own chain. And now it's changing the sort of competition between them from being sort of straightforward competition for exchange volume and users to can they get everyone building on their chain? Can they get an ecosystem there, a community there, and then make money through validator fees? Do you think the landscape has changed quite significantly? And do you think that is now the real point of competition between them?
I would probably push back on the idea that, ecosystem building is the primary factor that differentiates. Like the reality is these guys have massive distribution, right? And they don't need to cultivate like a super novel or unique ecosystem. If you look at Base, right, most of the usage on Base is not on apps that are exclusive to Base or novel on Base, right? It's just what Coinbase has done is provided this really tightly vertically integrated experience from you go onto the exchange and in one click, your assets move onto Base and you're either earning yield or you're financing or whatever. So yeah, I think there's an ecosystem curation aspect, which is you don't want a bunch of shitty protocols that are populating your chain, and that's all that's there. You want high quality protocols, but I don't imagine that they will take a ton of risk, right? In contrast, you could look at like a Mega ETH. Mega ETH's ecosystem is totally unique, right? It's the protocols that are launching on Mega ETH only live there. And so they've taken the opposite bet, right? They don't want to be a general purpose chain. They don't have a ton of distribution users yet, but their bet is like, we're going to provide a novel experience that you can only get on our chain, so the users will come, right? Coinbase and Robinhood aren't there. They have millions of users. They don't want to take risk where they can avoid it. But there's pretty low hanging fruit. Like you offer lending, you offer yield, you offer borrowing, and this is net new functionality that users have not, their users have not been able to access before. So yeah, that's kind of my take.
Okay, and then most exchanges seem to be focused primarily on staking as sort of yield options. Some of them have lending. Why should people use vaults instead of going for staking rewards?
First off, staking is staking yields are coming down, right? That's just sort of the reality. And if you think of staking as the risk-free rate, there's always demand for a little bit more, right? Staking yields are compressing. There's more you can do if you go beyond staking. So I think it's just, as an exchange, you want to offer products for the whole spectrum, right? And probably if people are using an exchange, they're not like the most risk averse people in the world, right? It's not like I just want to stake my ETH and not do anything with it, or stake whatever asset. They want to do things with it. They want to earn higher yield. They want to express their preferences. So vaults are really a general purpose tool to do that. Staking is definitely the gateway drug. This is like how you get people comfortable with yield, and definitely liquid staking is a really interesting portal into DeFi, but it's just inevitable, and we're already seeing it, right? That people want more than just staking.
And vaults have used previously in the past, they've offered quite high APYs. What sort of APYs can people sort of expect right now?
Well, there's a huge spectrum, right? Again, our vision is like a vault for everyone. So if you want just low risk lending, on stable coins, that's like 4-ish% on chain, there's vaults for you, right? If you want strategies that take leverage and maybe have exposure to basis trades like Ethena, you could probably get 8 or 9%, maybe even 10%. ETH similarly, right? There's strategies all the way from 3 to 4%, which is staking, all the way to 10%, which is doing things like taking leverage. So we have a huge product diversity at this point. We have dozens of vaults in production. We have around 10 vaults that have 100 million in TVL, which I think is very unique, right? Any single vault reaching that is very difficult. We've been able to reproduce that again and again.
And do the vaults tend to be managed strategies or passive ones?
So this is a mix, right? There's vaults that are effectively LRTs that don't do anything, right? They just stake, and under the hood, they're doing restaking or whatever. Then there are vaults that are doing more interesting things like liquidity provisioning, lending, taking leverage. We want to be agnostic, right? We are a technology provider. We want to support all kinds of strategies. It really depends on the goals as a protocol. I can tell you that the more active strategies, active products, tend to have higher margins and are better for monetization. But the more passive ones, there's advantages to those as well. So yeah, basically it's all of the above.
Are there any platforms offering DeFi indices yet, or DeFi indexes?
So do you mean like, ETF style products, or indexes of DeFi tokens, or any of that?
Like baskets of DeFi tokens?
Yeah. We've tried this in the past, actually. A couple of years ago, our team built some of these products, and nobody gave a shit. Nobody wanted to use these things. And I think there's a core reason for this, right? Like index products have just historically always failed. And the reason is that people in DeFi have very, very strong opinions, right? It's like you very rarely find a person who is like, ETH is the best, but, I want some exposure to Sol as well, right? It's usually one or the other. It's like, we love ETH, we love Sol. And so that also is the same case for different DeFi projects. So far, just because the user profile is more sophisticated, very opinionated, we haven't seen DeFi indexes be successful. But again, with the Robinhoods and Coinbases moving on chain, I think this is a new user base that will be interested in these products. So it's something we're keeping an eye on, even though we don't have any of those in production today.
And are you starting to see any vaults that are using AI in some way, whether that's in terms of like running the strategies?
We are seeing a lot of projects try to do this. My personal opinion is that it's too early. right? Like, I don't know about you, but I personally would not trust my own account to an AI. I think it would probably fuck something up. But it is definitely the future, right? Now, the hard part is not actually the algorithm side. Like, the models are going to keep getting better and we'll get there. The hard part is, how do you build a capital base that actually trusts you, right? And you can retain. So I think the successful way to do this, which is our approach at Veda, is build that capital base, right? And progressively integrate AI models into the optimization side of things as they get better and more reliable with human safeguards, right? Versus the opposite approach of like day one, today, we have these autonomous agents that perform decently for 95% of the time, but 5% they do something completely stupid and lose your money. So yeah, we'll see it happen. It's going to happen inevitably, but I think it's too early. And these projects claiming that they have these solutions are, I'm pretty skeptical of them.
Yeah, I actually moderated an AI panel recently and I asked for any legitimate products that weren't snake oil, and didn't get many names, so it wasn't a great sign. Cool. And then finally, so what are you working on over the next 6 to 12 months?
Yeah, there's a lot of exciting stuff coming out down the line. First is just access to more chains. So I think we've announced this in the past, but we're launching on Solana very soon. So that's pretty exciting. Just our goal of supporting all the possible chains and making that accessible to users. We're going to continue doing that. But on this path of like exchanges and fintechs, we will have some exciting news that should come down the line soon. So new products, new distribution channels, new partners. There's a lot cooking on the Veda side.
Sounds exciting. Well, that's what we have for today. I want to thank Sun for joining this episode. And as a reminder, the newsroom works tirelessly to get you accurate, informed crypto news. If you want to stay ahead, read the blog. Thanks, and see you next time.